Hello, and welcome to this lecture on auto loans during the 2008 financial crisis. In this case study, we will look at what happened in the auto loan market, a market in which non-bank lenders play a large role when short-term funding dried up. We will see that not only banks are susceptible to runs, and that a drop in credit supply led to a drop in auto sales. Before the 2008 financial crisis, about half of all auto loans were originated by captive finance companies. A captive finance company is a lender that is owned by the automaker, for instance, Ford Motor Credit, GM Financial, or Toyota Financial Services. The map shows you the distribution of market share of captive finance companies across US counties. As you can see, the market share is particularly high in Michigan, where most of the automakers are located, in the South, which historically had less banks than the North, and in the West. In other words, captive finance companies were particularly strong where there was less access to bank credit. Different from banks, captive finance companies do not take deposits. Instead, captive finance companies funded themselves by issuing asset-backed commercial paper and asset-backed securities. Let's first discuss how asset-backed commercial paper worked in this context. A captive finance company would establish a trust and transfer auto loans into that trust. The trust would then issue commercial paper that is backed by the auto loans and the cash flow from these loans. The trust uses the proceeds of the asset-backed commercial paper issuance to pay the captive finance company for the loans. Typically, these trusts are revolving. This means that the captive finance company puts in new auto loans as old auto loans are being paid off. By doing so, the captive finance company has continuously access to short-term funding, which in turn allows the captive company to issue new loans. However, commercial paper has a maturity of at most 270 days and needs to be rolled over continuously. This means that the captive finance companies, just like banks, borrow short-term and lend long-term. That is, they engage in maturity transformation. Asset-backed securities are slightly different. Here, the captive finance company sets up a trust and transfers the auto loans into that trust. The trust raises money by issuing longer-term notes. Here's an example from Ford Motor Credit Owner Trust 2018B that issues almost $1 billion in notes. The notes will be backed by a pool of car, light truck and utility vehicle loans bought by Ford Motor Credit. As you can see, in this transaction, the maximum maturity is 7 years, a much longer financing horizon. So, there is not much maturity transformation in this deal. At the same time, you can also see that the longer maturity, the higher the interest rate on the note. Moreover, this is a one-time deal, meaning that different from asset-backed commercial paper, the pool of loans will not be replenished and the loan payments are used to pay off the notes. Before the 2008 financial crisis, asset-backed commercial paper was the main source of funding for captive finance companies because it was cheaper than asset-backed securities and revolving. However, when the subprime crisis started to hit the mortgage market in 2006 and 2007, investors became suspicious of the qualities of loan pools backing asset-backed commercial paper. One question that was asked was, how many subprime auto loans were in those loan pools? When investors discovered that the pool from the General Motors Acceptance Corporation was of low quality, the concern spilled over into the auto loan market. Investors were less and less willing to roll over asset-backed commercial paper backed by auto loans, reducing funding available to captive finance companies. The response of General Motors Acceptance Corporation was dramatic. In October 2008, General Motors Acceptance Corporation announced that it would considerably tighten credit standards and would only lend to consumers with a credit score above 700. At the same time, The median credit score was 720, meaning a large number of potential auto buyers would be denied credit. Other captive finance companies had also already tightened their credit standards. Nevertheless, investors refused to roll over asset-backed commercial paper, and this funding dried up completely. The collapse of the trust meant that the captive finance companies had to pay off the asset-backed commercial paper. General Motors Acceptance Corporation and Chrysler Financial Incorporated were unable to meet their obligations and collapsed. The unwillingness of investors to roll over the asset-backed commercial paper is in essence the same as a bank run. Short-term funding is withdrawn by all investors simultaneously, leading to the collapse and liquidation of the trust. Let's look what this run on the asset-backed commercial paper trust and the resulting credit crunch meant for auto loans. This graph shows you the year-over-year growth rate of auto loans. As you can see, they turned negative in early 2006 when the subprime crisis in the mortgage market started to unfold. But when investors stopped rolling over asset-backed commercial paper in mid-2008, loan originations dropped by over 30% when compared to the previous year. What happened to auto sales? As you can see in this graph, before funding for finance corporations dried up, US households bought about 16 million new cars at an annual rate. When the financial crisis hit, retail auto sales collapsed to 7.9 million at an annual rate in the first quarter of 2009. The timing suggests that the drop in auto sales was driven by a drop in credit supply. But how can we be sure that the drop in auto sales was not driven by low demand? During the financial crisis, many workers lost their job, and bleak economic prospects could have made consumers hesitant to buy new cars. If the collapse was driven by demand and not by reduced credit supply, we should see that other lenders were not stepping in and making loans when captive finance companies could not. However, this graph shows you that in 2008, more auto buyers paid either with cash or got credit from a bank or a credit union. This suggests that runs on asset-backed commercial paper had significant consequences for auto sales. The example of captive finance companies illustrates that runs can occur outside the banking sector. Indeed, every financial institution that engages in maturity transformation can be subject to a run. However, before the 2008 financial crisis, regulators had largely ignored maturity transformation and credit provision by non-bank financial institutions. These non-bank financial institutions had no access to the Federal Reserve as the lender of last resort that would help to stop the runs in the short-term funding markets. These runs, through their effects on credit supply, contributed to the depth of the recession that followed. What have we learned in this lesson? First, with captive finance companies as an example, we showed that non-bank financial institutions engage in maturity transformation. Second, non-bank financial institutions experienced runs in the funding markets during the 2008 financial crisis. Third, the runs reduced auto credit and therefore auto sales.